Hi, everybody. Welcome to the show. Welcome to Every Money Show. It's your Uncle Seth and Paul. Paul, we are analyzing Palantir off of our Patreon request. People have been asking about this. People in our live streams has been asking about this company. I know very little about it, but what we're going to do right now is show you the stock health of a company. We're going to look at all the metrics in our 8-pillar analysis, and we're going to look at Palantir. It's a Denver, Colorado company, and they recently popped yesterday, Paul, up 10%. I guess the U.S. Army is exercising some options. And I've read articles on their free cash flow is improving. So we'd like to look at Palantir. You laugh already.
You really read an article?
Well, there's articles about free cash flow that's going to be its savior this year. Is its free cash flow. So I'm eager to learn. Go ahead, Paul. Tell me about this company.
So Palantir was founded in 2003 by somebody that I respect a lot, Peter Thiel, whatever. He's the guy who offered $100,000 to you to not go to college and come there and like be a businessman and entrepreneur with them. He has a lot of similar philosophies. He's a libertarian. Mm-hmm. He's a chess former. He was 1 point away from chess master and didn't get it.
Come on.
He was 21.99. I like him a lot. He is the one that supposedly funded Hulk Hogan's lawsuit against Gawker when they released that video of Hulk Hogan having an affair, and it caused Gawker to go bankrupt. Palantir, I don't exactly know what they do. They're a software business of some sort. The reason we're going over this company is a lot of people have asked about it, and I immediately looked at the financials and said, not for me right now. Why is that? Because they lose money. My philosophy, and one of the things that I want everybody to understand when they come listen, is there's a lot of money to be made in businesses that are already established. Are they less sexy? Absolutely. Is it more sexy to see a company like Palantir, which just went public, this year? It went public end of September, and now they were public at $9.50, and now they're at $28. I mean, that's super exciting. In a matter of 6, 7, 8 weeks, they've gone up 3 times. That's very exciting. But I'm of the philosophy that over long periods of time, the financial stability and the fundamentals of the company will drive the stock price. Okay,
Paul, we get busted up in our comments, and feel free to comment below, but we get busted up a lot that, like, why would you make a video on a company you have no idea what you're talking about? This is a growth stock, and you guys are all wrong. And the key is, Paul is trying to educate in that we don't care what the company does. We want to look at the math and see if it's a solid investment, not a hype stock, right?
Not
Paul?
Exactly.
Go on.
We do care what the company does, because remember, when people say to me, Paul, a former classmate of ours the other day texted me and said, Paul, I want to come and talk to you because I respect what you do. I want to understand the value versus growth aspect. To which I said, well, value entails growth. Growth is still a big part of the value proposition. When I'm valuing a company today, I'm still going to factor in the future growth potential of that company as part of my value today. The difference is when other people look at growth, they're looking at this growth, the stock price growth. I don't look at the stock price growth. I look at the growth of the financials of the company. I still very much care about the growth prospects and what they're doing. That's super important. But I'm not willing to overpay for growth. I have a model that sits there and says, okay, if growth is X, and growth of income is Y, what's the growth overall going to be? What's the value going to be of the company based on a metric? Everybody else looks at this and says, hey, this is a stock that's going up like crazy. That growth potential is huge. I love it. That to me isn't growth. That's just the public's perception of the value of the company, right? So you're telling me right now, if the company had gone from $9.50 to $4.50, it'd be a crappy company? Guess what? The financials are still the same either way. They're going to be the same. 1 month later, the financials aren't going to be any different than from if the company went to $28, $280, or zero. The financials are the same. So the whole point I'm trying to make is growth is an important aspect to every fundamental and value investor. It is part of the story. Warren Buffett even says, when I hear people talk about value versus growth, I feel like they're just being redundant. Value is growth. Growth is value. If I were to, the example I always give is, let's say you're a company, and here are the profits for the next 10 years. 1, 2, 4, 8, 16, or until I run out of space. 32. So how many years is that? 6 years. This is a massively growing profit company, right? Okay, great. Would you pay $300 for it today?
I don't think so.
Of course not. Why? Because the next 6 years you're going to get a lot less than $300. Would you pay $1 for it today?
Of course.
Absolutely. So there's a price between 1 and 300 where it becomes a good value and where it becomes a bad value. And that's the art of investing. With Palantir, people are looking in other growth stocks like Tesla and other things like that. They're looking at the growth of the stock price and saying, look at this growth company. I don't say a company's growth because of the stock price. What I'm trying to teach you is that growth is about the fundamentals. How's the revenue, profit, and free cash flow growing on a year-to-year basis?
We're going to look at those fundamentals right now. Paul will pull up Palantir. We're going to go through our 8-pillar analysis and analyze this company. We appreciate the early thumbs up. This does take a lot of work to do, and Paul's giving you all this knowledge for free. You don't have to give us a dime. Go ahead, Paul. What is the market cap for Palantir?
$53 billion. It's a big company from market cap perspective. PE ratio, negative. So it loses money. Look at this, minus 295%. We have two massive X's right here. They have a pretty good gross profit margin, though, 48%. And for those of you who don't know, gross profit is for every extra dollar they get bringing revenue, how much of that goes to the bottom line.
So theoretically, we always want a PE around 20 for our pillar number 1, and pillar number 2, we wanted
that as a starting point,
and our profit margin above at least 10%. Paul.
Again, I bought companies that had way lower profit margins. It's all part of like the starting point, and none of the 8 pillars should be taken by themselves as this is a good thing or a bad thing. It's all about painting a picture overhead.
Pillar number 3 is revenue growth over the past 5 years.
So here's the problem: we don't have 5 years of data. We have 2 years of data. 595 million, 742 million. Okay, sounds good. I mean, it's a check mark still for 2 years. Let's go to the quarterly level. But even on the quarterly level, there's only 3 quarters of data. I don't know why that is. 190, 289, 1 year to 1 year. So 50% revenue growth over the last year. Great.
How about profit growth is pillar number 4?
That's an LOL. I mean, they're losing more money. Minus 137, minus 861.
Yikes.
I mean, they're guys, that's the thing. When you look at just the stock price, you're not paying attention to the fact that it's actually losing more money as time goes on. And this company's been around for 17 years.
No, Paul, people say companies like this are young and they need to spend money to grow. And that
By the way, they do need to spend money to grow. I'm not denying that. I love Peter Thiel. I think he's one of the original investors in Facebook. He's phenomenal. But don't go pay for the nose for any. If that's the case, if you think 53 billion as a market cap is reasonable, why not 530? And you know what you'll say today? That's unreasonable. And guess what? If it went up 10 times like Tesla did in the last 2 years,
yes,
you'd be justifying $530 billion at some point in the future. Of course you would.
Yeah.
You're always going to justify, when you have no explanation for why a company's worth something, you're always going to justify what it currently looks like.
Let's look at pillar number 5, which is the number of shares outstanding. We want this number going down.
Check mark. It's the same. Good for them.
Very nice. How about current assets greater than current liabilities is pillar number 6, Paul?
So do they have enough cash on hand to pay off all their debts? Total current assets, to pay off their current debts, 2.4. Guess what? They have more than enough to pay off all their debts. That's a good positive. This is a major check mark here. This is the biggest one. When their current cash on hand can pay off all their more debts.
That's a good state to be in.
Example of that would be, let's say you have let's say you have $100,000 in your bank account and your mortgage balance, your car balance, all your debts that you have, everything, including your house, was less than 100,000. That's what that's like here. It's gonna be hard for you to go bankrupt when you have more money in your bank account than you have debts outstanding, than you have total debt.
The most important pillar you think is pillar number 7, free cash flow growth. You love free cash flow.
Okay, so free cash flow, we're gonna go quarterly look here. There is no free cash flow. So when they say free cash flow is gonna save them, now maybe in the most recent quarter ending September, we had a minus $285 million free cash flow just for the quarter. So this is an X and the multiple is an X. I mean, this is X's all around. Guys, here's what I'll say.
Go on, Paul.
If you want to trade this stock because you feel like there's so much momentum, I'm going to go trade it, fine. But if you're buying this based on fundamentals, I think you're making a big mistake. And I want you to understand what we're trying to teach here at Everything Money. We're trying to teach everybody to take to realize that there is a price to be paid for all assets based on a lot of assumptions. The assumption you're making when you see a stock price goes up is that somebody else will just pay you more later. That's the greater fool theory. I want you to understand, hey, I'm trying to learn to understand what is behind a stock. What's going to make a stock go up over long periods of time?
How many normal people are buying on fundamentals, Paul? This is
Not many.
This is news to a lot of us, including myself.
We get a lot of people who comment on our YouTube channel saying nobody's talking about this on YouTube. Nobody's talking about fundamentals. It's boring. It can be perceived as boring. I love it. But times like this are very tough for us. But there'll be times in the future. Somebody else commented yesterday, you're going to be out of stocks for the next 10 years. I'm like, no, I won't. I'll be in stocks. History has shown that we're already in the longest bull market basically in history. Even this year, we had an economic collapse and a shutdown, and we're at higher prices than we were at the beginning of the year. I mean, this is craziness. So I look at it saying, I'm trying to help you guys understand this so we can learn together to say, what is behind each company? How am I going to understand what's going on with each company? Mo is a guy that started learning value investing a year and a half ago. That guy would have bought on charts all the time. Now you should see him. He's like, I don't feel comfortable buying this until I read a 10K. That's Mo. I'll make a decision before reading a 10K sometimes if the company's big enough and the discount's big enough, or I'll skim the 10K. We're trying to learn here how to look at a company's fundamentals and see the future. For a company like this, I sit there and say, wait for it to, you might miss out on major gains here. But my comment to you is, if you're going to buy to this now, when are you going to sell? You'll have no reason to sell in the future if you ignore all fundamentals. So you're trying to guess that you'll see the fire coming and you'll be able to stay in just long enough to exit the door. I've heard this 1,000 times and it never ever works. And nobody is ever the fastest one out the door when the fire comes. At some point, you have to pay the piper. And I think that happens here.
If this analysis, this mathematical analysis resonates with you, feel free to join our Patreon, patreon.com/everythingmoney. The link is definitely down below. We have a ton of members talking about these more disciplined analysis of companies. Paul, I guess your take home is you'd never get anywhere near a company like this in terms of
from
investing.
A fundamental perspective.
Fundamental,
now,
for sure.
We're starting to do some momentum trading, but even this, there's not enough history yet. It's only been around since October, September. I need to have about 100 days of history before I start talking about momentum. 100 days, trading days.
As always, we post almost 2 videos a day nowadays.
2 videos a day,
it's
1
crazy.
o'clock and 7 o'clock Eastern
And
time.
we go live on Tuesdays and Thursdays at 1 o'clock Eastern time. Jump on and ask the exact questions you want to learn. And as always, we'll see you in Patreon. You will talk to Paul directly on a day-to-day basis, learn everything he's buying, selling, trading, puts, and everything else. Paul, thanks for analysis, and thanks for watching out there. We love you guys. Appreciate it.